Okay, you can feel it everywhere, right? This AI gold rush. It's all anyone's talking about, and the valuations, they're just astronomical. But it leads to the one question that's on everybody's mind. Is this a real deal technological breakthrough we're seeing, or are we all just riding a massive bubble that's about to pop?
To figure that out, we're going to have to do a little historical detective work. We're going to wind the clock all the way back to the year 2000, to the dot-com crash, and put it right up against the AI boom of today. You'll see the similarities are kind of spooky, but the differences, well, they're everything. So let's get into it. All right, so to kick this investigation off, we're going to zoom in on two absolute giants from their eras. And these aren't just any companies. No, these are the guys who weren't just part of the revolution, they were selling the actual tools to build it. So on the left, you've got Cisco Systems from back in 2000. During that whole internet gold rush, they weren't the ones looking for gold. Nope, they were selling the picks and shovels. You know, the routers, the switches, all the gear that everybody had to have to build the web. And on the right, you've got Nvidia today, selling the essential AI GPUs, the picks and shovels for this new gold rush. It's a perfect parallel.
Okay, so let's start with the bull case. This is the argument for why this time is different. We're going to look at all the evidence that suggests today's AI boom is built on something way more solid, way more profitable than what we saw back in the dot-com days.
And here's the absolute heart of the argument. Unlike so many of those dot-com companies that were just running on hype and speculation, Nvidia is incredibly, fantastically profitable. We're talking about a genuine cash-printing machine right here and right now.
Now check this out, because this is where it gets really interesting. Look at that price-to-earnings ratio. Back at its peak, the market was paying $200 for every single dollar of profit Cisco made. It was just pure speculative mania. But Nvidia, even with its insane valuation, is trading at a much more reasonable 47 times earnings.
And when you see it laid out like this, man, it just smacks you in the face. You can see just how wild things were for Cisco, completely detached from reality. Nvidia, on the other hand, looks so much more grounded in actual, real-world profits. The foundation, it just seems a lot more solid this time around.
And we're not talking about small profits either. We're talking about massive profits. With gross margins over 70%, Nvidia isn't just moving a lot of product. They're making an unbelievable amount of money on every single chip that leaves the factory. So, case closed, right? The bulls win? Well, not so fast.
Because this is where our little detective story takes a really sharp turn. If we just scratch a little deeper below the surface, there's another story in this data, and it's a story that sounds a lot more like a warning.
Yeah, hidden. Right there in plain sight is this one little metric, and it draws a line so perfectly, so directly from the peak of the dot-com bubble straight to today that you can't ignore it.
Okay, look at that bottom row now, the price-to-sales ratio. At its absolute peak, Cisco was trading at about 26 times its yearly sales. And Nvidia today, it's trading at almost the exact same multiple, 24 times sales. It's uncanny. This is the spot where the two stories become one.
Let's just pull that number out and look at it. 24 times. So what does that really mean? And why is this one number the entire foundation for the bear case?
Well, what it means is that for every single dollar in sales the company brings in, investors are willing to pay $24 for a piece of it. Now, for a company that makes physical stuff, a hardware company, anything over 10 times is historically considered the danger zone. At 24 times, the market isn't just being optimistic. It's pricing in absolute perfection for years and years to come, with no mistakes, no competition, nothing.
So why is that 24 by number so incredibly risky? Well, the answer is something called the Capex dependency trap. And you know what? It is the exact same trap that swallowed Cisco whole more than 2 decades ago.
See, Cisco's engine was fueled by the telecom companies, who were spending hundreds of billions on their network gear. Nvidia's engine today, it's being fueled by a tiny group of cloud computing giants, the hyperscalers, who are the ones spending billions and billions on their GPUs.
And we're talking about just a handful of companies here: Microsoft, Meta, Amazon, and Alphabet. These 4. Their spending, what's called capital expenditure or Capex, is what's driving almost all of Nvidia's insane growth. Nvidia's entire fate is basically in their hands.
And this is how the whole thing can fall apart. It's a quick, brutal, 3-step chain reaction. First, the big customers start to get a little nervous about how much they're spending, and they slam the brakes on. Then, almost overnight,
all those orders for the picks and shovels, they just vanish. And finally, that stock price that was priced for perfection, it corrects, and it corrects violently. This isn't a theory, it's exactly what happened to Cisco. And here's the real kicker. If these hyperscalers do pull back, the shockwave isn't just going to hit one company's stock price. A sudden stop in tech investment of this size could be the very thing that triggers a much wider downturn in the economy.
But okay, let's say a crash happens. Does that mean the tech was a failure? Is that where the story ends? Well, if history tells us anything, it's that a crash is often just the beginning of the next and, frankly, the most important chapter.
A market correction, even a really painful one, isn't a verdict on the technology itself. It's more like a necessary reset. It's the phase that washes out all the hype and speculation and actually prepares the ground for real, long-term, sustainable growth.
I mean, look at the timeline. The dot-com era had this massive overinvestment, right? Then came the crash. But what happened after the correction? That's when we got the real utility phase. That's when we got the cloud, smartphones, streaming, all the stuff we literally can't imagine living without today.
Think about it. All that fiber optic cable that the telecoms frantically laid in the 90s, well, after the crash, it was still there. And it became the super cheap, super abundant foundation for the next 20 years of innovation. In the exact same way, the billions and billions being poured into AI infrastructure today, it's not just going to vanish. It's going to be the foundation for whatever comes next.
So when you really step back, the big lesson here isn't just that bubbles pop. I mean, we know that. The real takeaway is that the stuff that gets built during the crazy, speculative boom is what ends up changing the world long after the hype is gone. The real internet revolution, it started after the dot-com crash, and the AI revolution will probably be the exact same. So the question it leaves us with isn't if this technology is going to change our world, it's whether we're ready for the turbulence that might just get us there.